Imagine you walk into a car dealership today. You tell the salesman your budget. Ma, he smiles, leans back in his chair and says, "Sir, for just $450 a month, you can drive that brand new SUV off the lot today." And you think, that's actually not that bad. $450. You can handle that. What he doesn't tell you, that $450 a month is for 84 months, 7 years. And by the time you're done paying for that car, you'll have paid $30,000 to $40,000 for something that is now worth half of what you bought it for. Welcome to the 84-month car loan, the financial trap hiding in plain sight. And today we're going to break down exactly how this works, why banks and dealers absolutely love it, and what it is quietly doing to the financial future of millions of middle-class families. Stay with me, because by the end of this video, you'll understand the exact formula dealerships use to get people to overpay by tens of thousands of dollars. And most of those people never even notice it. Let's get into it. To really understand why the 84-month car loan even exists, we need to go back a little bit. In the 1970s and 80s, a brand new car cost somewhere between $4,000 and $6,000. The average American household income back then was maybe $12,000 to $15,000 a year. So a car was expensive, yes, but it was kind of manageable. You could finance it over 36 months, maybe 48 if you were really stretching it, and you'd be done. Fast forward to today. The average price of a new car in the United States hit over $48,000 in 2023. That's not a luxury car. That's not some loaded pickup truck for a contractor. That is just the average. But here's the problem. Wages haven't kept up. Adjusted for inflation, the average worker today has less purchasing power than they did 40 years ago when it comes to big purchases like cars. So what did the auto industry do? Did they lower car prices? Did they invest in more affordable models? Shio? Ha. No. They did what the finance industry always does when something becomes unaffordable. They stretched the payments. First it was 48 months, then 60, then 72, and now 84 months is completely mainstream. Some dealerships will even offer 96-month loans. That's 8 years, on a car that will be worth almost nothing by the time you finish paying for it. And the thing is, it worked. People bought it, literally. Because when a salesman says, "It's only $500 a month," most people don't do the math. They just hear $500 a month. That sounds fine. That's exactly the problem we need to talk about. But first, let me show you the actual numbers, because once you see them laid out clearly, you'll understand just how expensive that affordable monthly payment really is. All right, let's talk real numbers. Let's say you're buying a $45,000 SUV, completely average these days. You put $5,000 down, so you're financing $40,000. And let's say your interest rate is 7.5%, which, honestly, in today's market, is actually considered decent. Now watch what happens depending on how long your loan is. Option 1. A 48-month loan. Your monthly payment is around $966. At the end of those 4 years, you've paid roughly $46,300 in total. Option 2. A 60-month loan. Your payment drops to about $800 a month. More comfortable, right? Total paid, around $48,000. Option 3. A 72-month loan. 6 years. Now your payment is $693 a month, but your total paid creeps up to nearly $49,900. And option 4, the 84-month loan. Your monthly payment is now just $609. Sounds pretty good, right? Your total paid over $51,100. By choosing the 84-month loan over the 48-month loan, you paid nearly $5,000 more for the exact same car. $5,000. Gone. Just because of the loan length. But it actually gets worse. Because of something called depreciation. The moment you drive a new car off the lot, it loses between 10 and 20% of its value, immediately. By year 3, it's typically lost about 40%. By year 5, sometimes 60%. So here's the nightmare scenario with an 84-month loan. After just 2 years, your $45,000 car might only be worth $27,000, but you still owe $34,000 on it. You're underwater. You owe more than the car is even worth. This is what the industry calls being upside down on your loan, and it is extremely common with 7-year car loans. Think about what happens now if your car gets totaled in an accident. Your insurance pays out $27,000, the car's current value. But you still owe the bank $34,000. You just lost $7,000. And your car. And that scenario plays out for real people every single day. Now, here's something I want you to know. Because this is where most car buyers get tricked. And it's not an accident. Dealerships use a specific psychological technique to make sure you focus on that monthly payment instead of the total cost. It's one of the oldest tricks in the book, and it works every single time. All right, I'm going to let you in on something. This is called payment manipulation, and once you understand it, you will never walk into a dealership the same way again. Here's how it works. When you sit down with a car salesman, one of the very first questions they ask, before they talk price, before they talk interest rate, before they show you any numbers at all, is this: what monthly payment are you comfortable with? And most people answer honestly, oh, probably around $500 a month. That's it. You just handed them complete control of the negotiation, because now, the salesman's entire job is not to get you the best deal. His job is to build a deal that hits $500 a month, regardless of what you end up paying in total. Want to keep it under $500? Easy. We'll just make the loan 84 months instead of 60. Done. They can sell you a $60,000 truck and still keep your payment comfortable by stretching the loan to 7 years. And most people walk away happy because, hey, it's only $500 a month. Meanwhile, the dealership just made an extra $8,000 to $10,000 in interest off of you, got you into a car you technically couldn't afford, and sent you home with a smile and a free coffee. There is actually a term for this in the car business. It's called payment packing, and it is completely legal. The fix. It's simple, but most people don't do it. Never. And I mean never. Start a car negotiation by talking about monthly payments. Always negotiate the total price of the car first. The out-the-door price. That means the full amount you're paying. Car, taxes, fees, everything. Before financing enters the conversation. Get that number locked down. Then, and only then, do you figure out the loan. And when you do get to financing, compare your bank or credit union's rates first. They will almost always beat whatever the dealership is offering you. All right, so we've talked about the mechanics. We've talked about the tricks. But there's a bigger picture here. A broader economic reality that most people are completely missing. And it goes way beyond just one car loan. Let's zoom out for a second. According to the Federal Reserve, Americans collectively owe over $1.6 trillion in auto loan debt. That is not a typo. Trillion. With T delinquency rates on auto loans, meaning people 90 days or more behind on their payments, recently hit levels we haven't seen since the 2010 financial crisis. And we are not talking about reckless people. We are not talking about people who just went out and bought a Lamborghini they couldn't afford. We're talking about normal working families who went to a dealership, got presented with a monthly payment that seemed manageable, signed a 7-year loan, and are now stuck. Here's the thing about an 84-month car loan that most people don't think about when they sign it. It doesn't just cost you money in interest. It costs you financial flexibility for 7 years. Think about what can change in 7 years. You might have a child. You might lose a job. You might want to move to a different city. You might have a medical emergency. You might finally decide to start that business you've been thinking about. But every single month for the next 7 years, you have a $600 car payment. Non-negotiable. Doesn't matter if you're thriving or barely surviving. That payment shows up. And because the car is worth less than you owe for most of that loan period, you can't even sell it and move on without taking a serious financial hit. This is the middle-class squeeze in action. You're not technically broke. There's a nice car sitting in your driveway, but you have zero financial flexibility. You can't build a real emergency fund. You can't invest. You can't handle an unexpected expense without reaching for another credit card. And the cruel irony? The fancier the car, the worse the trap. Because a fancier car means a higher price tag, which means a bigger loan, which means even more interest, which means you're underwater for even longer. It's a perfect spiral. And the people designing these loan products know exactly what they're doing. Which brings me to the question I know you're thinking right now. If this is such a bad deal for regular people, why does it keep happening? Who actually benefits from all of this? Let's follow the money. Because there are three clear winners when someone signs an 84-month car loan, and the buyer is not one of them. Winner number one, the banks and lenders. They collect years of interest on an asset that is losing value the whole time. The longer the loan, the more interest they collect. It's almost a perfect product for them. You're paying them money every month for 7 years on something that's worth less with every passing day. Winner number two, the car dealership. They love long loans because it lets them sell more expensive cars to people who otherwise couldn't qualify. A 7-year loan turns a $45,000 car into a manageable monthly payment. The dealership moves more inventory at higher price points. Everybody wins, except you. Winner number three, the car manufacturers. When financing is easy and monthly payments seem low, people buy newer, more expensive cars more frequently. Why keep your 5-year-old fully paid-off car when you can upgrade to something brand new for just $550 a month? And here is the loop that keeps the whole system running. As soon as most people get close to paying off their car, they trade it in and start a brand new 84-month loan. So they are essentially always in debt, always making a car payment, forever. In personal finance, there's a term for this. It's called the car payment treadmill. You never actually get ahead. You just keep running. And here's a number that really puts this in perspective. Studies have shown that if the average American invested what they spend on car payments, instead of perpetually buying new cars, they could retire with over $500,000 more than the average person. $500,000 just from rethinking the car. Now, I don't say any of this to make you feel bad if you're currently in a long car loan. I say it because knowing this changes how you make decisions going forward. So let's talk about what you can actually do. All right, enough talking about the problem. Let's talk about the solution. And I want to be clear. I am not here to tell you to never buy a car or to only drive some old beater with no AC and a check engine light that's been on since 2014. Cars are a necessity for most people. I get it. I'm just here to help you buy one without torching your financial future in the process. So here are 5 rules. Simple, clear, and worth writing down. Rule number 1. Never go longer than 60 months on a car loan. 48 is better. 36 is ideal. If you cannot afford the payment on a 48-month loan, that's not a financing problem. That's a car choice problem. The answer is to buy a less expensive car, not to stretch the loan longer. Rule number 2. Keep your total car costs under 15% of your take-home pay. That's everything. Loan payment, insurance, gas, maintenance. All of it. 15% or less. If you bring home $4,000 a month, your total car costs should not exceed $600. Rule number 3. Always negotiate the price before you talk about payments. Walk in, knowing what the car is actually worth. Use sites like Edmunds, CarGurus, or Kelley Blue Book. Get an out-the-door price you're happy with. Then, and only then, discuss financing. And always, always, check your own bank or credit union's rates before accepting the dealership's offer. They almost always beat it. Rule number 4. Seriously consider buying used. A 2 to 3-year-old car with 20 to 30,000 miles has already taken its biggest depreciation hit. You can often get 80% of the car for 60% of the price, and you can finance it over a much shorter term and be done with it faster. Rule number 5. If you're already in a long loan, make a plan. Can you refinance it to a shorter term? Yes, your monthly payment might go up a bit, but you'll save thousands in interest and get out from under it faster. Even making just one extra payment per year can cut several months off your loan and save you real money. The goal here isn't to drive the cheapest car on the road. The goal is to win the long game, and every single dollar you don't hand to a bank in car interest is a dollar that stays in your pocket, a dollar that can go towards something that actually builds your future. Here's the bottom line. The 84-month car loan isn't evil. It's not some underground conspiracy. It's just a financial product that was designed to benefit the people selling it, not you. And in a world where everything is sold to you in monthly payments, cars, phones, furniture, mattresses, streaming services, The most powerful financial skill you can develop is the ability to think in totals. Not, what is the monthly payment? But, what is the total cost? Every time you sign a long loan, you're making a bet that your life will stay exactly the same for the next 7 years. No job changes, no health scares, no emergencies, no surprises. History says that bet doesn't pay off very often. The middle class is being squeezed from every direction right now. Housing is expensive, healthcare is expensive, education is expensive. You don't have to add a 7-year car loan to that list. Drive a car you can actually afford, pay it off fast, and use that freed up money to build something real. Your future self will thank you. But if you found this video useful, go ahead and hit that subscribe button. We break down financial traps like this every single week, in plain English, without the jargon. And if you know someone who just walked out of a dealership with a crazy long car loan, share this video with them. It might just save them thousands of dollars. I'll see you in the next one.